So I want to welcome everyone to what I call our 2025 Portfolio Analysis Mastermind. For my investors, and I'm in Colorado, this is an annual event we do where we get people really doing three things: understanding their portfolio, understanding their goals, and understanding current market conditions. And you have those three items, and that's how you go out there and find the sweet spot that's right for you. Because what's right for me may not be right for Alvin, or what I'm doing now is not right for 22-year-old Chris 20 years ago. So with the big shift in the market, we all know interest rates have gone up, expenses have gone up. It is a brand new playbook, and we want to talk about the new rules for investing in a high interest rate environment. So the agenda today is I'll give a quick introduction about myself. I'll talk about how the Portfolio Analysis Mastermind overview works. It's more than just a webinar. We'll spend a few minutes talking about just the key market trends, because as Alvin alluded to, there's a really unique opportunity for landlords to convert equity into cash flow. And we'll spend quite a bit of time talking about my favorite metric, return on equity, or ROE. I think is the most important one for landlords to know about. And we'll go through a case study, what I call a red light rental, meaning there's lots of trapped equity and it can be working harder for you. And they'll wrap up with making sure everyone goes out there and takes action, because knowledge without you taking action, is just not ideal. So quick disclaimer on here, we're going to be using a lot of numbers. We're going to be showing some examples of potential things. We're not giving financial advice. We're not giving tax advice. Always go out there and talk to your professional team, and always double check any resources or numbers, that Al and I are sharing. This is stuff that we use ourselves to invest in, but always go into any deal and anyone you take information from, eyes wide open, and do your due diligence. So I live in Denver, Colorado. I've been an active landlord out here since about 2011. I've done a fix and flip. I did wholesale. I did some multifamily brokerage. And then I found my sweet spot for building a residential rental portfolio, a lot in the 1 to 4 units. And then I turned that into an investment brokerage business where I helped a lot of other landlords go out there and buy rental properties in Denver and Colorado Springs. And we've done close to $500 million worth of transactions and helped hundreds of clients go out there and get some great rentals in the market. And then what I'm really known for is our software called Property Llama. I'll give you a sneak peek here. This is software that myself and a couple partners and a great team started developing 3 or 4 years ago, with the idea of not helping people understand how to analyze a deal to buy. There's lots of great spreadsheets for it. This is to help people analyze, how do you analyze your current portfolio? What should you do to essentially rebalance it or optimize your portfolio? So we'll spend a lot of time in here and actually be using this. And then everyone go in there and get a free account to upload their properties. And then what I love about Property Llama and investing is my college degree is actually in financial planning. I'm a certified financial planner by education. I can sit for the exam. I never did though. And so how I view investing and how I view how to optimize your portfolio really comes from that financial planning mindset I have. And so I get to infuse that passion into real estate investing. And then I really focus on 2 things. I know deals in Colorado, and then I have really focused on some of these advanced financial metrics like the return on equity and how to optimize your portfolio. And that's given me the privilege of doing a bunch of YouTube videos with Bigger Pockets, speaking at their events, and just being with a lot of great people and great companies over the years to come talk about these advanced wealth building strategies. So getting into it, who is this mastermind for? This is really geared towards landlords with at least a couple investment properties who are trying to figure out the best way to optimize their portfolio and what's working in the market. And as Alvin alluded to, I am not a big guru fan out there, and I am not a guru. I think we've all, been to classes or been to workshops or probably swiped our credit card with a guru over the years. I'm sharing data that I've used myself. I'm sharing data that our team invest with, that our clients invest with as well. And this is all about helping people understand real strategies, understand their portfolio, and then having that mastermind angle. We can go in there and connect with other investors to hear what they're doing and also share what your thoughts are to make sure you get their input as well. And so we have broken this into 3 main parts with build to rent. So the step one is this webinar you're on right now. And this is the goal is to understand your current rental portfolio, align it with your personal goals, and understand the market opportunities. The second is you can then input your properties in the Property Llama software, and you can click that link or share or scan that QR code, and we'll send out the email with all this later. And that gives you a free account that Alvin was gracious enough to secure for everyone. And then connect with Todd on this team to go out there and get some one-on-one help. And then we are going to regroup in about 1 month on March 11th for our second webinar for a group mastermind session where people can come ask questions. And we'll also aggregate a lot of the data from what we see in Property Llama and the conversations that Todd and Alvin have with investors out there. But I want to jump into, excuse me, I want to jump into market trends here. And I very much balance, like I'm a keep it simple, stupid person. I very much balance, hey, what are the couple of key trends here that matter? I've been to many presentations by economists, and you get an hour long with a PowerPoint. You fall asleep halfway through, and there's no actionable item on there. That's not what we want to do here. We want to say, hey, what are the one or two things that really matter so you can understand it? And then most importantly, what does that mean for investments, and what does that mean for your cash flow today? So like I said, I use a lot of Denver stats here because I know Denver really well. And real estate's always about local stuff. So I think a lot of national data, has its pros and cons, but a lot of markets out here mirror what Denver has. And to put it simply, the hyper growth phase of Denver and many other markets, the Salt Lakes, the Austins, the Boise's, the Nashvilles, those hyper growth days are over. So this dark line here are single family homes. The dashed line are condos. And I highlighted this red box here, and this is when we had our crash in Denver from the 2008 great financial crisis, almost 15 years ago now, or a little more than 15 years ago now. At the time, I mean, it felt more like a cliff versus a slope, and the world was literally ending. But then what happened afterwards is we had just this amazing recovery, and this is where a lot of us went out there and built, great portfolios, great cash flow, and really increased our net worth, tremendously through this. And then what happened here is right in 2022, as rates started going up, that's when the party ended, right? Rates went up, and then we also saw, generally speaking, expenses go up, taxes go up, insurance go up, and all of a sudden everything started flattening. Now, Denver has kind of flattened out and has been very, very much appreciating below average. Some markets are the same, some markets are less, but this is where you want to make sure you get some good data on your market to understand it within the national macro trends. But from a high level, I always like to say a lot of us had this, double-digit appreciation in prices and rent growth for years. That's like a credit card advance. You eventually have to come and pay due. Well, if those numbers are really high for a while, guess what? The law of averages will kick in. And since we had years of double-digit growth, now we're going to have years of single and probably below average rent growth and price growth, along with all the other expenses starting to creep up on there. And then this is the last chart I'll show on markets. So this is since 1991, it shows just the statewide appreciation for all 50 states. And this is from the FHFA. And I highlighted the 3 states with the biggest appreciation since 91. So Montana being number 1 at 583, Utah close second at 580, Colorado at 569. And so those are the 3 best performing markets, with a lot of other markets, very close behind. What's interesting when I first saw this graph is look at California, right? A lot of states have outperformed California as a whole since 1991. And we always think of California as a high appreciation market, or the market that it's, hard to buy rentals in or no one can afford. But for the last 30 years, a lot of the U.S., especially the Mountain West and some of the South, has outperformed California. And then of course, you got some laggards over here in other parts of the country. So the point with this is, if we have had triple-digit growth in a lot of these markets, that's not cash flow, that's a price appreciation, and that turns into equity. And this leads us into the next part of the webinar, which is talking about how to turn appreciation to cash flow. Because I don't know about you, Alvin, but every time I talk to an investor, 99 out of 100, and myself included, we think, hey, I want $10,000 a month in cash flow. I want $22,000 a month in cash flow. I want cash flow. We think in monthly cash flow. Well, equity is great. We all get rich on paper. We all look really good on our net worth, but it's hard to pay the bills with that equity or that net worth. So with the market change and with all this appreciation that many investors have achieved out there, whether it's through the market or if you've done some amazing value add yourself over the years, is the key now is taking that equity and how do we convert that into cash flow in a tax advantage and meaningful way. And I talk about a lot of rental properties, not landlords having what I call a red light ROE or a red light return equity, meaning the hundreds of thousands of dollars of equity having a property is a red light, meaning it's underperforming. Now, let me expand upon that so you understand it. And this goes back to what I said. I think ROE is the most important metric that any investor or any landlord should know about to go out there and help evaluate your portfolio. And yes, it's even more important than your 30-year, 3.5% fixed mortgage rate, because I have personally sold quite a few properties the last couple of years that had 30-year rates below 4%. People thought I was crazy, and I show them return equity, and a year later, they're selling their properties as well because they got it. So let me break this down for you. We all know what ROI or return on investment is. So I view ROI as, hey, in year one, how much money can I expect to get from the cash flow, price appreciation or value add, from principal reduction or debt pay down, and then the tax benefits of depreciation. Those are the four ways we make money in real estate. And that's the numerator here on the equation. And then your investment is your down payment, your closing cost, your rent ready cost, your acquisition cost. And then year one, we say, hey, I put $100,000 down, I get $50,000 back, I get a 50% ROI. And this is great for year one, year two, but at some point, your investment no longer matters. Why? Well, because you start building equity. You have more than just your original down payment in the property. So here's pretty much the exact same equation, but I just swapped out the investment on the denominator on the bottom here and put in equity. Because if you fast forward to year five, what happens? You now have built up more equity through market appreciation and also debt pay down. So now you have a different opportunity cost on here and a different LTV or loan to value that starts really impacting your returns. Now, it is easier for me to show you at this point than keep showing you these PowerPoint slides. So here is a real condo I bought, and this is actually when I bought in Reno, Nevada many years ago. I bought it for $67,000. But guess what? I put $0 down. This was one of the best deals I ever did. True $0 down the closing table. Got really creative financing. Had a private investor on here. 100% financing of this property. I didn't have my first expense until about 4 weeks later for my first HOA and my first mortgage payment. So of course I bought this, when the market was in the depths. So I got it, for a third of what it sold for just a couple years before. So in my mind, I'm thinking here, wow, I bought this for so cheap. I put $0 down. I will never sell this property. It makes sense to just keep it forever. Well, as I got more experienced and I got around smarter and more successful investors than me, they started talking about return equity. Because in my mind, I was looking at the $0 down and I am making an infinite return on my money here. Now, this shows 0%, and because the system can't show an infinite return. But if I put $0 down, I'm actually making an infinite return, right? Any dollar you get over zero is infinity. So I'm like, wow, I have an infinite ROI. But then here's the kicker. I have a 7% or a 6.96% return on equity. And breaking this down, down here in the software, it's saying for the next 12 months, and this is supposed to be like a snapshot in time for return equity. So the next 12 months, I assume I'll make $6,900 in appreciation. I'll make $5,100 in debt pay down. I'll make about $1,600 in cash flow, and I'll get just under $500 in depreciation benefits. Altogether, about $14,000 in return I should make over the next 12 months. $14,000 and change. divide by $204,000 of equity, gives me that 6.96% return on equity. So my $0 I put in this property now had accumulated to just over $200,000 of equity. And that is my real estate piggy bank with a real opportunity cost in there. So here is a table that actually shows it, and I'll share the slide deck so you guys can download this if you want to see it in detail. But what happens here is your return on investment goes up over time because we're using dollars. You know, hey, 10 years ago I put down $100 and now I'm making $100 today. Time value of money issues there. Where return equity in every single real estate deal, or almost every single real estate deal, return equity starts declining every single year because your equity builds. And the other thing is you start losing leverage, and leverage is such a key component to having great wealth creation in real estate. So here's just a graph version of this example I showed you. And you can see here, hey, in the early years, it starts in the 20%, but just starts slowly declining every single year. Not bad, not good. It's just a fact, right? Well, and I just thought, hey, you get this and you pay off rental property. I'll sit there and just have 10 paid off rental properties one day and I'll retire. That wasn't until one of my mentors, and this may be the first guy I know becomes a billionaire. He said, hey, Chris, if your rental property only matches the stock market's return, why the heck are you a landlord? And that really shook my mindset. I had a major paradigm shift once he asked that question, because it got me thinking, and I was like, well, you're right. I should be outperforming the stock market, right? There's headaches, there's hassles, there's real liability with rental properties. I don't have real liability with my S&P 500 index fund. So here's that same graph, and I assumed a historic 10% return of the stock market return per year. And I highlight that here on the purple dashed line. And you can see here, your return equity a lot of times will get down to the stock market return, or in many cases, it will start falling below it, depending on the property mechanics. So if you're getting less than a 10% return or a less than 10% return equity, does that justify the landlord headaches and risk when you can get the same return as an index fund? Now, I'm not giving you financial advice here, of course. I'm just sharing you my thought process and hopefully getting you to think different ways. So in my mind, okay, I got this. I got three options here. One, I can accept a lower risk-adjusted return, which is not acceptable to me. If I'm going to get the same return, I'll just ride the stock market volatility. Second, I can optimize the property's performance. I can go in there and add a bedroom, add value, raise rents, reduce expenses. But a lot of times there's only so much juice you can squeeze out of a lemon. Otherwise, you stop getting juice out of there. Or third is the repositioning of your equity into better investment opportunities. And I bolded three because this is what most real estate investors do. And I'm sure a lot of you on the call have done this as well. So I'm going to flip over to the software here in one slide, but I want to show you this slide to highlight the red, yellow, and green light. And so this is my quick rule of thumb here for return on equity. If your return on equity is below 10%, that's red light to me. As I said, I'm below the historical stock market returns. That's not acceptable to me. Yellow light, 10 to 15% return on equity. So returns are decent, but not exceptional. Property probably needs attention optimization, but we know where this ROE is headed. It's going to continue to slowly degrade every single year in most cases. Green light is 15% or above. Now, I used to say 20% above when times were good. Now I'm happy with 15% above, as everything's a little tougher right now. But if you're 15% above, I consider that green light, meaning your property is performing pretty well. Continue monitoring it. So I want to jump back over to this condo example I showed you and run through three examples, because you actually have three things you can do with a property. You can keep it, you can refinance and pull money out and buy another property, or you can sell it and do a 1031 exchange to invest in the proceeds. I'd be curious in chat while I pull this up, who's done a 1031 exchange or who's done a cash out refi and buy, just so I know kind of like who's done what in the audience. So I'm back at the software here now. And I won't go through all the data on here. You can do this on your own time. Meet with Todd on Alvin's team. And of course, just go through our resources on here to learn how your property is performing. But this is that 6.9% return equity. It is a red light property. So we have this really cool feature in here called Run a Scenario, and allows you to do a quick high-level scenario or high-level modeling for what you can do or what you could potentially do with the equity in your property. Now I'm going to start with a cash out refinance because this is what I first did, and many investors want to keep the property and then buy another property. So if we do a refinance here, and I'm a big fan of this when the numbers make sense. So cash out refinance rates, Alvin, I mean, I see between about 7.5% and 8.5%. Do you get anything magical down there that better rates than I get up here?
The interest rates?
Yeah, interest rates. Sorry.
Oh, yeah, 3.75%.
Well, I'm saying for if I would do a cash out refi on this property, not one of yours yet.
Oh, do a cash? No, yeah, you'd be around there. Yeah,
so around 8% on a cash out refi. And I'm going to use a 6.5% cap rate, which is a lot of the properties that, Alvin and Bill Trent are able to procure out there. And then what I'm going to say here, and this is me keeping this condo I have, I'm keeping this red light condo. So I'm putting new debt on here at 8%, taking out money and buying a new one. And since I'm taking out really expensive debt on this property, I'm going to keep 35% equity in here and do a 35% down payment. So I'm not doing max leverage. So I'm going to click this scenario here. And the system's going to build out a model comparing, hey, if you keep this property, and let's compare out to taking the cash out and refinancing it. So there's some cool graphs up at top, but I'm going to really dive into this section here of this side-by-side comparison. This is my favorite part of the software. So the left side is my current condo, and we're going to focus on return equity and cash flow. So my return equity will actually almost double. It goes from 6.9 to about 12.5%. Great, right direction. Still yellow light, but hey, better direction, right? But look at this. Here's my cash flow. My cash flow actually goes negative because I'm going to go from $1,600 to negative $2,500 a year in debt. Now, you look down, I'm making more returns. I'm making, more appreciation, everything but cash flow. Why? Well, when you come down here and put new debt, and I'm putting on 8% debt on a 3.5% cap rate property, that's called negative leverage. We typically don't want to do negative leverage for long-term holds. And so I'm at negative $5,000 a year on there. And then I'm at $2,700 a year in cash flow on the new property. So I get some new positive cash flow, but I am not a proponent of holding negative cash flowing properties unless you have a really, really, really unique reason to do it. This is just too high risk and not a great use. So even though my return equity is increases, my cash flow does not. So the other thing I want to show, and then we're going to do some really fun modeling of actually showing what works out there, is let's do a 1031 exchange. So if I sell this property, and then this is me, I'm modeling selling this property and buying another property here in my market where we've had such high prices that it's no longer like a great rental market. So I'll keep the 8%. At best, I can find about a 6.5% cap rate property out here. I'll assume a 35% down payment for just a healthy down payment and a 6% cost to sell and transaction cost. So I'm gonna run this, and the system's gonna build this out for us as well to compare the current and the exchange. So left is a current property I have, right is the new one. So I'm going from a 7% ROE to 11.4%. And my cash flow will increase from $1,600 to $4,200 a year. So, hey, both are increasing. But here's the thing. I'm increasing a red to yellow, and I'm having a marginal cash flow increase. I mean, not horrible, but also not great. Because when we used to do these properties years ago, the numbers we used to see, I could sell this property. I could buy a new place at 4.5 debt. I could buy a 6% cap rate property, and I could do a 25% down payment. And life was really good because numbers were really good. And these are the numbers that I saw in Colorado. I think a lot of people probably saw around their markets as well, where return equity would 3x, cash flow would 4 to 5x. So things looked really good in the old market cycle. But when you're buying new properties in markets like a lot of the Denver markets and other markets where they appreciated a lot and no longer good rental properties, the numbers simply don't make sense anymore. So this comes down to my punchline. The old playbook simply doesn't work anymore. And in my opinion, it is not worth trading a red light rental for a yellow light rental. It is a marginal trade up. And for the transaction costs in real estate, the headaches, and also just the unknown of a new property and the stabilization period, it's not worth it. So does that mean real estate investing no longer works? No, it just means what we used to do no longer works. Let's find the new door, the new opportunities, and go through that. And this brings us to what I call a fork in the road, where in the previous market cycle, it was very easy. And I fall in this category to be a very hands-off, part-time, 5 to 8 hours a week, or some people call it a little bit of a lazy landlord, right? I could go put down 25% on a property, find a good deal, do my due diligence, get decent financing, get a good deal, and then turn the keys over to property manager for a long-term rental. And the numbers would be green light, ROE, and a good 5 to 8% cash on cash return. Awesome. Well, those opportunities, as we just talked about, no longer exist in majority of the markets where I live in and many other people live in there. I'm not saying there aren't opportunities here in Colorado. Like, there's some amazing active opportunities right now. But you know what's cash flowing right now? People go out there and buy a 4-bedroom house, can add 3 bedrooms and a bathroom, and then manage 7 bedrooms individually. Now, if I was 22 years old, I would do that strategy. But now I'm 42 with a wife, 3 kids, and I have a lot less time and more capital than 22-year-old Chris Lopes did. So those opportunities aren't attractive to me. So that's not the right one for me. I think it's the right one for Alvin. It's not the right one for a lot of landlords who have grown up in this last market cycle. So you can either be very hands-on and be like, I call it like a 20-plus hour a week operator, or you got to really focus on not being that middle of like the hands-off landlord, but being a lot more passive. And that is really saying, hey, how can I go out there and be more of a deploying my capital? How can I go out there and find really good deals in this marketplace and limit your sweat equity? So that's your time, what you're doing into there, because putting in a few hours a week of sweat equity right now does not give most people a good return on their time. I'd be better off out there just working more at my job, doing more of my business. I'll make more money that way than I would by putting a few hours a week by being a hands-off landlord. And then this brings us into what I think is one of the best opportunities in the market right now. And again, this is really for people who've been in high appreciated markets and they're looking for ways to go out there and continue to have good cash flow and good growth. And this opportunity is why Alvin and I have become good friends over here the last few months, because they're experts at this. And the opportunity is to 1031 exchange into turnkey new construction properties in stable, higher cash flowing markets. As I've said a few times now, Colorado, many of the markets, has up and came. I don't know if that's proper grammar, but up and came, right? The growth wave is over. So now the opportunity is, hey, there are sub-markets out there that are stable. They're not saturated with new inventory. They don't have, high expenses and low prices. So you can get good, stable cash flow in that 5 to 10% range. And then the other opportunity is, as a lot of builders have built properties over the last couple of years, they're now sitting on inventory. And we all know retail buyers, owner-occupant buyers, aren't out there like they used to be. And so a lot of times they'll go out there and say, hey, I need to get this property off my balance sheet. This is where Alvin and the build to rent team come into play, where they've got that great connections with builders to go out there and get new construction properties. So you get brand new stuff with the modern layouts, the modern amenities, the big walk-in closets, the builder's warranty on there. And then they pair it with low interest rates that builders can buy down on multiple properties. And I don't know, I know, Alvin, you and I talk a lot about this, and I don't want to put words in your mouth, but this is your expertise. What would you add on here that I did not touch on?
Yeah, so a couple of things. One, you mentioned it correctly, where like a lot of our times our default setting is to invest locally. But that's always our default setting. A lot of us want to do that as a default. And whenever I do an investor call stage, I always jokingly ask, so why don't you invest in San Francisco? Why don't you invest in New York? And they will tell you their answers, right? They will say, hey, well, it's a tenant-friendly state. Property tax is too high. It's too costly to invest in here. I have to buy a super beater and still have negative cash flow. But they'll walk you through it. So the default setting is to invest locally. And then what we find is, hey, are you looking for the best deal available, or are you looking to drive yourself crazy, just continuously searching? And so a lot of investors have realized that I need to keep deploying my capital. I need to keep putting my money to work. Most investors understand that real estate is the greatest form of wealth building that there is, because of, as you mentioned, the 4 ways of building wealth. And then it's simply looking at, like, where are those deals available? So what happens is that in markets like Denver, like San Francisco, like Seattle, like New York, like even Miami or Tampa or Orlando, the land costs have gone way too high. And there's always a limit on how much you can charge somebody in rent. Once you start hitting that $2,500 a month, you're kind of capped. You can't. It's really difficult to charge somebody more than that amount. And so what happens is, when you're in a expensive market, the numbers are never going to work because of the land cost. So instead, what we do is we look at the areas that have higher rents, but nearby, 30 minutes drive away, the land costs are dramatically less. And you can give tenants more. So instead of just a single 1-bedroom condo, you're now giving them a 4-bedroom home for that same or similar rental rate. But because the land is so much cheaper, you can actually buy it for a lot less. So you're giving the tenants a lot more value while also buying a lot less on the purchase price. And so we talked about this last time, but we used to negotiate heavily on purchase price. That used to be our thing. We would go heavy on purchase price. And what's happening now is, if you put an 8% interest rate next to almost any deal, your deal is not going to work. So now we negotiate heavy on the interest rates. And so we have several loan programs available to our investors that they can go as low as 3.75% interest rate. Now, if you put a 3.75% interest rate on a pretty good deal, that deal becomes so much better. And so that's where a lot of our investors are now saying, like, I have this equity, but I feel trapped. It's almost like if you're playing casino, you're up big, but now there's no more use for these chips that you accumulated. The solution is you got to cash it in, because the return on your equity is always zero. And I always say, you could hold on to that property and it could possibly double in value in 5 years, 10 years. But what if you traded that property in for 4, and then the market doubled in value? Well, now you would have 4 properties that double the value, as opposed to just 1 property double the value. The debt pay down and the appreciation are going to be the fastest way of building wealth, but you need that cash flow to justify it. And so without an alternative way of getting the cash flow, you're just going to be stuck and trapped in your equity.
So I know before this, Alvin and I always, I get the inventory that Alvin and Build to Rent have. And there's this really great duplex. This isn't the Ocala market, right?
That is the Ocala one, correct? Yeah.
Yeah. So it's a 2-2 duplex, so nice side by side. And won't go through numbers on here, but of course, reach out to Alvin and Todd to get this and to get the offering memorandum on here. But the punchline, the highlights and the variables on here is, this is a fixed 3 3/4 interest rate. And 2 years of free property management at just under a $400,000 purchase price.
Yeah, that's a 10-6 arm, so it's fixed for the first 10 years, which most investors are not going to hold a mortgage for 10 years anyway.
No, because you should be doing a 1031 before then usually. And that's actually a side note. That's one of the great things I like about that. Alvin talked about the the interest rate expiring on there. And a lot of times you look at the sweet spot, that 5, 6, 7 years, often a sweet spot for it. And also, if you take a new build, hey, after 5, 6, 7 years, that's when some CapEx will start creeping up. And it's a great time to go out there and then trade up into whatever the next latest, greatest opportunity is at the time. So going back to my red light condo here, my 3.5% cap rate, 7% return equity. Let's say I sell this. and I'm going to invest, or I'm going to invest and buy, buy one or two of these properties in Forest. So I'm going to put in a 3.75% interest rate. This is I think it was a 6.2% cap rate, right? Yeah, 6.2% cap rate. And we're going to do 25% down payment because I have positive leverage here. My cap rate is a couple points higher than my interest rate. And I'll assume a 6% transaction cost for selling my property out here. So the system will do the side-by-side comparison, and let's look at the numbers on here. So I'm going to, spend $14,000 in transaction cost. But look at my return equity. My return equity, 4X's. It's going from a 6.9 to a 24%. My cash flow is, I don't know, that's like 7 or 8Xing from $1,600 a year to about $15,500 a year. And Alvin, I know you started mentioning a few minutes ago, kind of like the 4 ways people make money with real estate, but especially with some of the new construction you have. Do you want to break down the way people make money on these new properties you have?
Yeah, I do want to point out that if you sell that property, you can probably buy 2 of these duplexes for the value you're selling that one out. So it's worth saying you can go either 50% down, which would be probably too much putting down, or you can buy 2 duplexes. So in this example, we're buying one while still having another $80K sitting there on the sidelines. So yeah, so the 4 major ways of building wealth through real estate. We all know cash flow. Most of us in our careers, depending on where you are, is you're not living off the cash flow today, but you need the cash flow in order to, it's like the heartbeat of the deal. If your deal doesn't have cash flow, don't buy it, it's dead. Leave it alone. just abort. But the other way is appreciation. I always jokingly say that every property you buy is 75% off. And it's 75% off because you're only putting 25 into the deal. Your tenants are paying off the other 75%. So you just have to wait 30 years. But if you look at it that way, it's like you're getting a massive discount that I can't do that with gold. I can't do that with any stock. I can't even borrow money from Chase to buy Chase stock, right? They won't allow me to do it, but they will allow me to do that with real estate. So the leverage is it's an accelerator of wealth, and someone else is paying it for you. The other part is the debt, you have the debt pay down, then you got the appreciation. So in this market, we may be at 3% appreciation. We all know that none of us are forecasting a huge amount of appreciation right now in today's market, but over the long run, absolutely we're going to see it. So right now we're in a time period where buyer demand is tempered, and they're tempered by the interest rates that they can't get through us because they're retail buyers. But once we see a little inclining of interest rates going down, or once we start seeing buyers kind of understand that these interest rates are going to stick one or the other, buyers are going to come back into the market, and then it'll be a frenzy all over again. So I anticipate that in the back half of this year, we will start seeing a lot more accelerated appreciation. The 4th way of building wealth, and this is for a lot of our doctors or lawyers or business owners, they think, making $700 a month in cash flow is cute because they have $1 million payroll. So if you have $1 million payroll, you're not that interested in the cash flow, but you do care a lot about keeping the money that you earned. So the tax benefits is massive for a lot of high net worth individuals, but quite frankly, it works for all of us. And so, Chris, I don't know if you're in this category, but I get money back from the IRS every year because I depreciate heavily. So what I do, so you can use a standard depreciation, which is basically dividing the improved property value by 27.5%, and that's just standard depreciation. You can also do what's called bonus depreciation, where you're going to depreciate up 80% of the first 5 years, all in the first year. And so you can easily save about 30K from doing a bonus depreciation. Or if you are a real estate professional, or even if your wife is a stay-at-home mom or doesn't make that much from her current job, you can actually make her a real estate professional. And then you can start using a cost segregation report. Now, a cost segregation report is basically looking at the property like it's a truck, and each component of it will break down in different time periods. So you're going to depreciate each component of that property at different stages. That now allows you to now really ramp up the amount of depreciation you can have. So much so that I'm mandated to buy a property every year just because I understand the tax benefits so well. So when you add it all together, and I think you have the total there at the bottom, you get
$46,000 for year one.
And that's, if you think about the money you put invested, you're getting, you don't have the number there. So you're getting close to 35% of the initial investment back in year one. And just your wealth building right there. So it's absolutely, insanely powerful. But again, the benefit is tapping into that equity and using that leverage.
Great explanation on there. And yeah, if you're not familiar with the tax benefits depreciation, that's I think the most complex part of real estate, but also one of the best ones out there. And a couple of things I'll point out on here is, the cash on cash on this property is estimated to be 8.1% in year one. So that is a healthy cash on cash return. And I like to see that 5 to 10% range. So that's right in that range. And another thing about buying a lot of properties like this in markets, we're using very just standard assumptions for depreciation in areas where they're not high cost living areas. Usually the land value is very low. So you actually get more depreciation on your investment than if you're buying in like the city center or somewhere hot, where the structure value is a lot more than just the land value of it. So these are just some slides I had in case the software is not working, but similar things here. So what you can do here is definitely come back here and play around with seeing, hey, how the opportunities are. And what the software does, it did assume this was like, hey, buying essentially 2 of these duplexes out here, because it's just saying, hey, we're taking all the money. Now, in reality, hey, I'm bringing an extra $20,000, $30,000 at closing table, because each one probably needs $100,000 and change for some closing cost. We can see here, great, 1031, bring an extra $20,000 at closing table, and look at that potential increase in performance of your rental property. I know we have some questions here. We'll get to those in just a few minutes. So one thing that I encourage everyone to do here, because this is one of the reasons why I was excited to, connect with Alvin originally, and then we're doing a lot more webinars in collaboration where I get to teach some techniques to his audience. We've been sharing his inventory when he has with my audience out here in Colorado. It's because we both really focus on, hey, let's make sure we educate the investor. Let's make sure the investor is making the right decision for them, because there's no one right thing to do in real estate investing. It really comes down to what's right for you and your situation and your risk tolerance. So my recommendation for anyone goes out there, makes any moves on their properties before any cash out refis or sell or buy, here's what I ask and recommend to people. First, understand the performance of your rental property. The second is make sure you come realign and clarify your goals. Like I said, a lot of times I talk about how when I started investing in real estate, I was single. I had a lot more time, a lot less money. Well, now I'm the exact opposite. Wife, 3 kids, busy with a couple businesses. I have more capital, and time is precious and sleep is precious to me right now, right? So I'm a very different phase of my life for what I want to be doing with my time. I want to get a really high return on my time, either through my work, through my investments, or with my family out there. So anyone can go out there and scan this QR code or use this link to go out there and create your free property allotment account. And this will be linked to Build to Rent. We have done a joint venture with them so they can use the software, and also then they can help you go in there and understand and optimize your portfolio. Now, create your account. It's free. It takes about 5 minutes per property, maybe 10 minutes. You have to dig up some information to go in there and put the in there. Needs the purchase price, the date, and current operating expenses, and your loan information. And it'll give you a really good snapshot of how your property is performing. Second, review your property level cards on here. And I really just touched on like the tip of the iceberg, what you can look in here. You can run scenarios. You can come down here and look at, your projected monthly income. You can come in here and play around with the assumptions on here. You can see how this property would be in 5, 10, 20 years. There's lots of great data on here you can play with and then dig into, additional education on here. But I encourage everyone to come out here and understand how your portfolio is currently performing and really focus on the metrics that matter. Return on investment matters when you buy, not when you're analyzing your current rental property. You buy a property through investment. Oh, go ahead.
Yeah, and I would add something as well, is when you're looking at your risk profile, you also have to take a look at the actual property itself and what's around the corner of needing to be replaced or repaired. So if you're looking at an older inventory, like how old is your roof, how old is your water heater, how old is your air conditioning, how old is the carpet, countertops. And so what you're going to find is, like for myself, I used to do a lot of investments in Pennsylvania where properties were very cheap and you would cash flow a little bit. So on paper, that looked great. It was a cheap property, cash flow a little bit, that was good. But then we would have a water heater go out, and that's $4,000. And so, if I'm making $100 or $200 in cash flow, how many years is it going to take me to replace this water heater expense? And so the longer you can go without having any CapEx or major expense, that's going to mean a lot to because again, there's a difference between on paper and reality. The reality is if there's no ROI on a brand new roof, right? So you can't increase the rent, doesn't improve property value. So also, take into account the actual risk of the property itself.
So come in here, do that, understand your rental portfolio. And then the other thing I recommend is go in here, like I said, realign and clarify your goals. Like I said, things have changed. I always like to joke that, hey, 15 years ago, I had a slimmer waistline. I could see my abs somewhat. Doesn't matter what I did 15 years ago. My clothes fit me today, right? Today's body, today's performance. So just you want to come in and do your goals. So in the software on here, it asks you a couple key questions on here for portfolio tracking, or I should say, portfolio goal tracking. Hey, what's your long-term valuation goals, equity goals, NOI, and cash flow goals? And you can put these in here. And then as you do these comparisons, like this red line shows my cash flow goal of $180,000. It'll actually come in and help you model, hey, how close are you to your goal? Hey, does this trade up? Does this get you above your goal? Does paying off this property get you above your goal? It's a really good way to go out there and have like that 50,000-foot view of performance in your portfolio. Now, of course, this is to get you thinking and exploring. Then you want to take this information and go sit down and really dig into your spreadsheet and get down to like the decimals. Go talk to your CPA. Go talk to your local realtor for what it would take to list a property. Talk with Alvin, whoever you're potentially looking at that up-leg property for, and then really dive in the numbers. This is help you understand the high level. Hey, how can I get from where I'm at to 10 years from now to get my goals? Now, one thing I always like to encourage people to do, and these are just some questions I've put together myself. I look at the financial performance of a property. Hey, what's my return equity, right? Hey, this is a 7% return equity I have. It's red light. Cash flow and equity. This is one thing I completely forgot to touch on here. And this is a really fun thing to talk about because people say, hey, I've got this paid off property or I've got this really low interest rate. I'm cash flowing really well, right? Hey, you bought property 10 years ago. You got cheap debt. You're paid off or you're getting paid off. You start seeing a good difference in cash flow, $500, $1,000 a month. Don't look at the pure cash flow. Look at your cash flow on equity. So in this example, my cash flow on equity is 0.8%, not 8.0% like Alvin's property, but it's 0.8%.
So
and what this is
the other way of looking at that is that if you were to buy that property again today, what would the returns be? And that's what that's showing you.
Yep. And you actually took out my favorite question.
Oh, I'm sorry.
No, this is great, Alvin. This is why you get along so well. Like my very first question when I say I'm going to review a property is, hey, but would you buy this property again today at today's price? And the answer is usually no, right? So I love it. And so I always, I do the financial analysis. I'm like, hey, would I buy it today? What's the best thing about this property? What's the biggest headache? Does this align with my long-term goals? Could this equity work harder for me? Am I happy with my cash flow numbers today? This is a very simplistic SWOT analysis, but these are key questions I like to ask myself and also challenge investors out there to answer it. And it helps to give you an interesting thing. But this question right here, would you buy this property again today? Man, once people say that, it often changes the decision. And then one other section, then we can open up to Q&A, I think, for a couple minutes here. And this is what I take myself through. I take my clients out here in Denver with is that was property specific. And this is your goals. What's your current monthly cash flow? What's your target monthly cash flow? And what's your target year? I am all about quantifying your goals. People say, I want a good return. I want to retire one day. Well, that's not accurate. That's not quantitative. No one can go out there and help you do what you want to do. So, hey, what cash flow do you want and what year do you want to buy? I want $10,000 a year in cash flow by 2029. I think it's very helpful for people to have a reality check of what type of investor they want to be. I'm much more in the passive phase right now in my life. Like I said, just because I've got 3 young kids and I like to hang out with them. I like to sleep. And then come down here and, ask other questions of, hey, what's working well in your portfolio? We all have properties that have done really well. We all have a couple properties that maybe aren't doing the best, right? Either the market went sideways. You're like, oh, wow, I bought that deal. And yep, I learned a lesson on there, right? I've done that more than once for sure. What keeps you up at night? And this kind of goes back to a risk tolerance question. I am very comfortable with leverage. I am very comfortable with, cycling properties. I don't worry about that. I worry about it when I have like no leverage and my properties aren't working hard for me. Other people, they're like, oh, I've got 7 figures of debt across my portfolio. They're awake at 2 a.m. stressed about it. I don't stress about that, but if you do, I don't think many investments are worth you laying awake at 2 a.m. or you and your spouse getting into arguments or, being nippy at each other. The other thing I always tell people is really go out there and identify what's the best use of time. What's your ROI on your time? Because I've had people like, oh, I want to go out there and find an amazing deal. I'm going to go out there and knock on 100 doors a week. I'm going to go out there and make 100 phone calls. I'm going to go out there and drop 1,000 mailers. I'm like, okay, but you make, say, $75 an hour at your job. And you're doing activities that are $25 an hour activities. And you're going to find a deal that, hey, if you spend 300 hours into this, you find a deal that saves you $10,000. But if you put that $75 an hour into other stuff, you would have made $30,000. In my opinion, that's not the best use of your time.
To add to that point is if you were going to have a super high success rate, I think a lot of us would trade in our time for a high success rate or find a really good deal. A lot of us say, you know what, for a week, I'm going to do it. And so a lot of times the time you have to also take into account the enormous amount of failure rate that you're going to experience. So it's not just like a one-time effort. It's all the compounding time. Because even if someone does respond to your mailer, doesn't mean that that's it. You got a good deal. There's a lot of elements that go then after that. And then you might be still stuck with a horrible deal after all of this work. So the failure rate and the multiple points of failure are the other parts you have to consider. And then you have to also consider who's your competition, who else is doing this, and people have entire businesses designed to do this. How do I outcompete? How do I beat those groups that are doing this full time?
Yeah, that's such a great point. I was actually speaking at a local real estate conference here this Saturday, and I talked to a flipper. Actually, he's an ex-flipper. The market got too tough, but he's like, at the peak, we were spending $50,000 a month on mailers, bandit signs, Facebook ads. It's like, okay. That's what you have to do. You're scaling a business and you're spending $50,000 a month to go out there and get to compete with the I buy ugly houses guys. That's hard to do for me. That's hard to do for most people. Another thing too is just really come down and get more clarity on what's your market view. Like I used to be like a lot of people, oh, I got more doors, the better, right? 100 doors is the best. No. I see Alvin, you're chuckling. More doors is not better. There's how many doors do I need? What's the right number of doors I need to go out there and achieve my goals? And a lot of times it's a lot less than you need. Your time and energy, and also just identifying what your biggest challenges are. Hey, not enough cash flow, too much time. The market may have turned. You've just got a lot of poor performing properties now. So, hey, if you've had 300% growth, the market's retracted 10%, great. Sell for a 290% gain and then move on with a 1031 exchange or pay taxes and put the money in annuities in the stock market for simplicity, right? As I've said numerous times, there's no right way. It all comes down to what's right for you, what's right for your family, what's right for your risk tolerance. And that's one of the great things about working with Alvin is that, he and I share a lot of the same philosophies. And we are here to be a resource for you. So to kind of wrap up this webinar, what I recommend for action steps on here is step one, go create your property llama account, and we will share this link. So I'll drop in the chat here, go create your account, and then it'll take you 5 minutes per property to go out there and do it. And then Alvin, you've got a team member who's been trained in portfolio analyses and also trained the software, Todd, where people can go schedule one-on-one. Can you talk more about your process and how Todd works with investors?
Yeah, so it's not just Todd, it's also some of our other district managers that are bringing on their own clients to the deal as well. So the key is all of our district managers are average 10 years over 17 years of experience, and 17 years of experience being an actual investor or being in the investment field. So Todd has over 22 years of being a property management company owner. He actually sold his property management company after I don't know how many doors he sold. And then also you have others like Susan, who is actually a hard money lender before she ever got to working with investors to help them buy properties. But these are experienced investors that we're talking about, and it's more of a consultation. So we're investors, we're actively buying deals ourselves, and we're speaking to you from the perspective of, does this make sense? Does it make logical sense? And the empowerment that we get from the tool that we have here is now we're talking very tangible. Like we can actually look at numbers, we can look at your current portfolio, look at the performance of the deals you currently have. And then we're just wrestling with different scenarios. So there's not going to be a clear cut. Well, there might be a clear cut, yes, you should sell. But sometimes it's just the idea of like, hey, how does this look in the future? One of the keys is that when you decide you want to sell a property and you're looking to do a 1031 exchange, one of the biggest challenges is being able to identify another property, a replacement property. You have 45 days to do so once you have sold the original property. So by speaking with us, we're going to have a chance to walk you through what are some possible options. And then if you know you can identify another property, maybe you'll feel more comfortable selling your current property. Our default, my general advice is to never sell, right? That's the general advice. It's a fruit tree. You never want to crush the fruit tree. Just keep picking from the tree, keep eating the fruit. But the reality is, if there's a way better use of your equity, then you have to be a good steward of what's given to you. And you're probably due for more blessings to come your way. You got to put yourself in a position to receive more blessings to come. So if you can trade in one property that you can't tap into the equity and buy possibly 4, that's a whole nother round of blessings that are coming. And again, I look at it like if the market were to double, would you have rather owned 1 property or owned 4? Like, well, if you owned 4, then now all of your properties doubled in value. So the wealth building is possible. We're going to sit down and walk through different scenarios. We already have the inventory in place, so we can very quickly in a 2-call process get to the point where you're looking at probably the best option for you.
Yeah. So create the account, connect with Todd. And as a side note, I did not realize Todd had a property management background. I think those are some of the best people to connect with, because everyone's, oh, I got these great numbers. Well, you got to buy a good deal. The other side of the coin is you have to operate the deal, and operating the deal is not always the easiest thing. So I think Todd's expertise with property management is a huge, huge point to meet with him and learn about your portfolio and learn about some of these new ones. So upload your property software, connect with Todd, and then come back and join us on March 11th at 3 Eastern, I believe, for our second webinar. We'll do some live group Q&A, some small mastermind sessions on there. But also we will be able to aggregate some data and aggregate some opportunities or trends that investors are doing. And we'll come back and share some of that data while also answering people's questions. So Alvin, thank you so much for allowing me to come on and talk with you and your audience. It's always a privilege, and I've just enjoyed it so much.
Yeah, it was an absolute pleasure. Again, the next thing to do is to go ahead and sign up, create your account, start plugging in your portfolio, start plugging in your properties, schedule a consultation to have more in-depth meeting. And then we're going to have that second webinar where we're going to talk specifically about what we've uncovered through this exercise. And I think when you start seeing other people's decision, what other people decided to do after they analyze their own deals, Then there's a sense of, there's strategy involved, and different people are going to go through different strategies. So we're going to show you real case studies and real examples of what we came out of these exercises together, and that will be the big reveal. So this is a big setup, but the actual second webinar is where we deliver the goods.